We're analyzing Palo Alto Networks, stock ticker PANW, to see if it's a great business on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Palo Alto Networks. Then we're giving a final rating to the business. This analysis is going to be intense, but it's going to be worth it. It's around 10 minutes. Before we get into these valuable metrics, let's understand Palo Alto Networks stock performance. Right now, Palo Alto trades for $213.95 per share. Year to date, they're beating the market. Their stock price is up 45.5%. In the last 5 years, Palo Alto is compounding at 24.5% annually, beating the market over this time. In the last 10 years, they're compounding at 31% annually. This also is crushing the market. Going back to when Palo Alto Networks was publicly listed 11 years ago, their stock price is compounding at 24%. The company's stock is up nearly 10 times in just 11 years. They're crushing the market. Palo Alto is trading $40 below their 52-week high. The company's up more than $80 from their 52-week low. There's some short interest in the business. 6.5% of their shares are sold short. Palo Alto Networks is a big company. They have a $66 billion market cap. But the burning question is, why should we be paying close attention to Palo Alto Networks? Palo Alto Networks is a platform-based cybersecurity vendor with product offerings covering network security, cloud security, and security operations. The California-based firm has more than 85,000 customers around the world, including more than 3/4 of the Global 2000. Now with that understanding, let's get into the numbers. Starting with metric number 1, we want Palo Alto's average return on capital in the last 5 years to be above 14%. The average business earns 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Palo Alto had negative returns in all 5 of their last fiscal years. Things have changed for the business in their last 12 months, however. Their returns are now positive. Still, when these returns are averaged out, Palo Alto's earning negative returns on capital, meaning this is an X on metric number 1. It's great to see that Palo Alto now has positive operating earnings though. Metric number 2, we're looking for 5-year revenue, net income, and free cash flow growth. This metric's all or nothing. All 3 need to be up for it to be a check. We'll also include their last 12 months worth of numbers in our calculations. Those won't show up on this chart. During these last 5 years, Palo Alto's revenues are up 2.5 times. The company had negative earnings in all 5 years, but their earnings or their net incomes are positive in their last 12 months, meaning these are up as well. Palo Alto's free cash flows nearly doubled to their last fiscal year in 2022. In their last 12 months, these free cash flows have nearly tripled from where they were at in 2018. This is strong growth across the board for Palo Alto. Our first check of the day coming in on metric number 2. Metric number 3, we're looking at Palo Alto from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. We're taking a slightly different view of their financials, looking at their last 12 months. Palo Alto had negative earnings per share in all of the last 5 fiscal years. However, in their last 12 months, really into their fiscal 2023, Palo Alto has grown their earnings per share. These are now positive. While their earnings today are positive for the first time in this 5-year period, Palo Alto has also diluted shareholders by 19%. This is not necessarily out of the ordinary for these big software companies, but that's a lot of shareholder dilution nonetheless. Their shareholder dilution is both a mix of share-based compensation and through acquisitions. Like many other tech businesses, Palo Alto has grown through acquisitions. In the last 3 years alone, the company spent nearly $2 billion to acquire other cybersecurity companies, issuing shares for some of these acquisitions. Ideally, we don't like to see that as long-term shareholders in a business. Either way though, because their earnings are now positive, this is a check on metric number 3. Metric number 4, we're looking for free cash flow per share growth in their last 5 years. Palo Alto has had positive free cash flows in all 5 of these years. Their free cash flows have nearly tripled over their time when we include their last 12 months. This is outpacing their shareholder dilution of 19%. Palo Alto has grown their free cash flows per share, meaning this is a check on metric number 4. To recap, so far we have 3 checks and only 1 X through 4 metrics. How will Palo Alto keep doing? During recessions, it's overly levered businesses that can have the biggest losses. Metric number 5, we want Palo Alto's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. Palo Alto ended fiscal 2022 with just under $400 million in net debt. Today, they actually have a slight cash position. They're sitting on $11 million in cash. In these last 5 fiscal years, when we add up their free cash flows, Palo Alto produced $5.8 billion of free cash flow. That's more than enough to support their debt position. Palo Alto generates a lot of free cash flow compared to the debt they're using in their business. This is a check on metric number 5. Now it's time to get to a valuation of Palo Alto. The big metric of them all, metric number 6, we want Palo Alto Networks' average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Palo Alto Networks. Right now, Palo Alto has a $66 billion enterprise value. This accounts for both their market cap and their net debt position. It gives a view of the business similar to it being a private company. In their last 5 years, we learned they produced $5.8 billion of free cash flow, meaning in an average year, they produced just about $1.1 billion of free cash flow. When that's divided by their $66 billion enterprise value, we get around a 1.6% average free cash flow to enterprise value yield. On a current basis, Palo Alto produced $2.7 billion of free cash flow in their last 12 months. When that's divided by their $66 billion enterprise value, we get around a 4% current free cash flow to enterprise value yield. Their current yield's about in line with the yield from the 10-year treasury, but both of these are below the risk premium we're looking for, meaning this is an X on metric number 6. Don't just throw Palo Alto Networks out. We still need to estimate their fair value per share. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Palo Alto Networks, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of Palo Alto's last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for their business. Palo Alto has a low degree of business predictability in their past, in part due to their high growth. Assuming they grow their average 3-year free cash flows at 20% annually for the next 10 years, then in the following decade, assuming that this growth rate is cut in half and these grow at 10% annually, we're adding in their tangible book value to give an estimate of their net worth. This could be skewed based on their shareholder dilution, so that's something you want to factor in. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, if today's valuation multiples are the same 20 years into the future, an estimate of Palo Alto Networks' fair value per share is around $106. That's down almost exactly half from today's current stock price. Keep in mind some key points. Again, Palo Alto has not been that predictable in their past. This limits how accurate some of these assumptions can be, so that's something you want to take in mind with these estimates. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll talk about our final rating for Palo Alto, but we need to address something first. We've covered the numbers, but the qualitative factors are even more important for their business. What are they? Let's find out. Looking at the factors supporting a long thesis, number 1, the company stands to benefit as clients consolidate vendors and opt for a platform-based cybersecurity approach. Number 2, Palo Alto's strength in the high-margin firewall space should allow the firm to generate substantial cash in the future. Number 3, Palo Alto has strong secular tailwinds behind its back as endpoint security, cloud security, and the convergence of networking and security are projected to grow rapidly. But it wouldn't be fair if we didn't look at the negatives of their business as well. Looking at the factors supporting a short thesis, number 1, there always remains a risk that Palo Alto may miss out on the next big technology, thereby allowing its competitors to catch up. Number 2, Palo Alto's competitors also utilize a platform approach, thereby entrenching them in their clients' ecosystems and making them harder to displace. Number 3, large public cloud vendors often offer their own cybersecurity solutions, which could hamper Palo Alto's growth opportunities. There you have it for a balanced perspective of some of the qualitative factors of Palo Alto's business. Now it's time to give our rating. In analyzing Palo Alto Networks, stock ticker PANW, we learned this cybersecurity company has grown rapidly. They just posted positive operating income and positive earnings for the first time in the last 5 years. Their revenues and their free cash flows are also up big. However, they've diluted shareholders by nearly 20%, which is a potential issue with a lot of software companies. Even though they just had positive earnings, they've generated positive free cash flows in all 5 years. They've grown their free cash flows over this time, and it looks like they comfortably comfortably and easily support their debt position using their free cash flows. Again, this analysis is not financial advice. Right now, Palo Alto's free cash flow to enterprise value yields don't look attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis, from today's valuations, if these multiples are the same 20 years into the future, you believe those assumptions and you want a 15% rate of return, an estimate of Palo Alto Networks' fair value per share is almost exactly half their stock price, coming in at $106. Palo Alto last traded at those levels at the end of December of 2020. Looking at all the factors of our analysis, Palo Alto Networks looks like a modest candidate for further research. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about Palo Alto Networks, and let me know what business to look at next in the comments below. Thanks for learning about Palo Alto Networks with me, and have a great day.